Welcome back to Financial Accounting. In the second part of Chapter 1, we will introduce the accounting equation and several definitions that are used in the accounting cycle. These concepts are extremely important to understanding everything else that you will learn in the course. I'll repeat. The accounting equation and definitions you are learning in this chapter are very important. They are like the foundations of a building. It will be the base for your success this semester. Let's start learning the language of accounting, starting with the accounting equation. The accounting system reflects two basic aspects of a company: what it owns and what it owes to creditors and back to its owners. Assets are resources a company owns or controls. Examples of assets are cash, supplies, equipment, and land. The claims on a company's assets, what it owes, are separated into two parts: what is owed to non-owners and what is owed to those who own the company. Non-owners are called creditors and may be suppliers, lenders, employees, or tax authorities. We refer to the amounts a company owes to its creditors in future payments, products, or services as liabilities. Owners are also known as stockholders. Equity, which is also called owner's equity or capital, refers to the claims of the company's stockholders. Together, liabilities plus equity provide the funds the company uses to acquire assets. The accounting equation must always be in balance no matter what. Let's define the parts of the accounting equation in the next few slides. Assets equal liabilities plus equity. You can think of assets as things and stuff. Think about what you personally own, such as a car, a house, or a computer. Those are your personal assets. A special type of an asset is a receivable. When an asset has the word receivable in its title, it means the company expects to receive money in the future for work they already performed but for which they were not yet paid. A company that provides a service or a product on credit is said to have an accounts receivable from that customer. For example, you don't pay your cell phone bill every time you make a call. Usually, you pay once a month. The cell phone company then has an accounts receivable from you until you pay your bill. Liabilities are what a company owes to other people or businesses. Think of all the money you owe to banks, utility companies, and individuals. The people we owe are creditors. Liabilities occur because the company has received something for which they haven't yet paid. Liabilities often have the word payable in their title. The term payable refers to a promise made by the company to pay or provide a service in the future. It's exactly the opposite of a receivable. Examples of payables are wages payable to workers, accounts payable to suppliers, notes payable to banks, and taxes payable to the government. Going back to my previous example when we talked about receivables, you personally have a liability and accounts payable to the cell phone company for the use of your phone each month. Equity is the owner's share of a company's assets after liabilities have been paid and is equal to assets minus liabilities. This is important. Assets equal liabilities plus equity, and therefore, rearranging the equation, equity is equal to assets minus liabilities. Please make sure you understand this equation. Equity is divided into two parts: contributed capital and retained earnings. Contributed capital is what the owners have contributed or invested in the firm in exchange for common stock. Remember that a corporation is formed to earn money, and the accumulation of earnings, net income, is the goal of the company. We refer to the amount of net income retained in the company as retained earnings. A company can keep its retained earnings, or it can pay it to its shareholders in the form of dividends. Dividends represent the distribution of a company's assets to the stockholders and reduce retained earnings. Again, dividends represent the distribution of a company's assets to the stockholders, and dividends reduce retained earnings. 4 types of events affect equity. For the purposes of telling our accounting story, we will describe those events using the following titles or accounts: common stock, dividends, revenues, and expenses. Equity is increased by owners' investments in the company through the purchase of common stock and by revenues. Equity decreases when the company pays dividends and incurs expenses. To more easily write our novel using the language of accounting, we need to put the 4 parts of equity we just described into the accounting equation with mathematical signs. To repeat, common stock and revenues increase equity, and dividends and expenses decrease equity. Think about common stock and revenues as payments into the company, and dividends and expenses as payments going out of the company. Let's look at the equity part of the accounting equation a little closer. Common stock is an accounting element that is not affected by anything other than owners' investments in the company. It will always increase equity. However, retained earnings is more challenging to understand. Retained earnings is increased by the amount by which a company's total revenues have exceeded total expenses and reduced by the amount the company repays to its shareholders. Retained earnings is actually the perfect name. It is the amount of net income retained in the company after dividends are paid. So whatever increases net income, revenues for example, will increase retained earnings. Whatever decreases net income, expenses for example, will decrease earnings, retained earnings. And whatever increases or decreases retained earnings will have the same impact on total equity. Please read your textbook carefully to make certain you understand the accounting equation and the definitions of assets, liabilities, common stock, retained earnings, dividends, revenues, and expenses. Okay, that's it for now. See you in our upcoming discussion about transaction analysis, and please let me know how you are doing.